All righty, folks, we have the one and only Mr. Crash Up, aka Joseph Wang, aka Fed Guy 1, 2, or 12. Joseph, how you doing, man?
Hey, Michael, thanks for inviting me. It's a pleasure to be here. Great to see you again.
Absolutely. I'm so happy we get to do this again. In our last episode, which was about 6 months ago, you articulated something that I think you've really become known for, and that is the term crash. Why don't you explain what that is, what you meant at the time, and maybe even where we are today?
Yeah, so my expertise is looking at how the monetary system works, and based on that, trying to figure out where we're going to go when it comes to asset prices and markets. And so, based on my understanding, I think what we're in is what people conventionally call a crack up boom. Uh, the way that I look at this is one of the big things that's changed today compared to the past is that we have this humongous fiscal deficit of about 6% per year that's expected to continue basically forever. And
Oh,
we've never ran this country this way before. Now, in the past, we always had people who were worried about the deficit, who would want to cut spending. We'd have people who would want to spend more. But at the end of the day, we would have some kind of compromise. But right now, that's really changed. Everyone in Congress would like to spend more money. They may differ on what they want to spend it on, but they all want to spend more money. Now, the way the financial system works, a 6% fiscal deficit is basically buying goods and services by printing treasury securities. In a sense, it's like debasing your currency. Well, actually, it literally is debasing your currency. When you think about it, a $100 bill is not too different from $100 in treasury securities. Now, again, these things, treasury securities, not literally money. You can't go and spend it and buy stuff, but it's very much it's like an IOU from the government. It's very much dollars. So what we're doing right now is we're basically printing and spending, 1.5 trillion dollars a year for the foreseeable future. When you
mm,
do that, obviously you're going to get a lot of upward pressure on asset prices and upward pressure on inflation. Now, what we've seen over the past few months is that we inflation has been a bit stickier than people thought, right? I think if you rewind a bit, maybe 2 years ago, you'd have everyone tell you inflation is transitory. Don't worry about it. It's going to go away. And that was anything but. And then afterwards, they tell you that, this is going to pass really soon. It's going to go back to 2%. Everything's going to be okay. But here we are, seemingly stuck at about 3%. And that's about right, I think, given the tremendous amounts of deficits that we have. Inflation is a complicated topic. It depends on supply factors. It depends even on psychology. But if you have a large fiscal deficit, it's really hard for you to get inflation back to 2%. Now, so I wouldn't think too much about trying to predict the level of inflation other than it's going to be hard to get back to 2%. I think what's much more predictable though is how this fiscal deficit filters into asset prices from stocks to gold to silver to housing. Now, the way that our economy works is that we have tremendous amounts of uh, income inequality and wealth inequality. So what that means is that, when you pour, you throw a bunch of money down, everyone gets some, but some people get a lot more than others. And what do rich people do when you give them a lot of money? They go and they buy assets. And so when you print a lot of money, you create tremendous demand for assets. So that means stocks go up, gold goes up, housing goes up. And so that's what I think of as the crash up. And this looks like it's going to continue for the foreseeable future. And I'm sure, as we'll talk about later on, we have this huge catalyst going forward, and that is a November election where things could really accelerate depending on who wins the White House. Because from what I hear, at least one party is thinking of taking this to the next level.
oh, oh, one of the parties wants to spend even more. That ought to make it interesting. So again, when I think about our conversation from 6 months ago and this notion of crash up, I was like, I wasn't sure it was possible, right? It's just I guess logically speaking, outside monetary, outside of this, like how could stuff go up? We've got to have a recession, right? I was in the camp 6 months ago where I thought a recession was happening 6 months away. Clearly didn't happen. I was clearly wrong. But you know, do you, when you look at the situation or the economy, can you see a recession, or does the government spending at these crazy 6% levels mean a recession won't happen? It'll just be lumpy.
So Well, let's level set a little bit as to what a recession means.
Sure.
So every year, the economy produces a bunch of an amount of goods and services. A recession means that you're producing less this year than you did in the past.
Hmm.
Usually, I think the rule of thumb is that if you have negative GDP growth, that is to say, you're producing fewer goods and services this quarter compared to last. You do this, you decline 2 quarters in a row, you
Hmm.
call that a recession. Now, I mean, that could definitely happen, but I think what's different this time compared to the past is that usually you would expect there to be a recession and then maybe prices come down, maybe unemployment goes up and so forth. I think the tremendous amounts of deficit spending are going to change that a little bit, and that we can produce fewer goods and services, go into technically a recession, but prices don't really come down much, and
Yeah.
maybe the unemployment rate doesn't even go up that much either. So, on another way
Yeah.
you can think about this is if you're putting so much money into the system, you're basically very close to being at capacity in the economy. And if you're a factory and you can only produce so many cars a year, you can't continue to grow indefinitely. Eventually, your growth is going to slow down, and it's going to feel when you look at the numbers like you're in a recession. But it's kind of because you're at capacity.
Yeah. You're normalizing. Yeah, that's interesting. Obviously, there was the experts, the market was calling for 6 rate cuts, January of this year. I think the current guess is 2. But when you look at sticky inflation, somewhere between 3 and 3.2, when you look at an election, which will certainly be market moving, when you look at government spending, I mean, is it more likely than not we have no rate cuts this year, or where do you come down on rate
I
cuts?
think
Have you
we'll have
given it
2 or
thought?
3 rate cuts.
Oh, wow.
So
Okay.
the way the Fed looks at this is that they're thinking that they're being super, super restrictive at 5.5%
Yeah.
interest rates, right?
Yeah.
So that's
True.
how they look at this. Now, inflation last year was as high as 8% year over year, and now it's come down a lot. It's come down, let's say, a little bit more than 3%. And so, from the Fed's perspective, yeah, we had rates really high, 5.5% when inflation was at
Mm,
8%, but we've made so much progress on inflation. It's coming down. It's not at 2%, but it's come down a lot. So, if it's come down a lot, it doesn't make sense for you to keep rates still at 5.5%. You got to adjust that a little bit, right? So just so
mm,
that you don't over tighten. So I think the Fed is becoming more concerned about potentially over tightening, given that inflation is getting so much closer to their target. And so they're telling you that they're thinking about cutting. Now, now I don't know what they're going to do. My best guess is we'll have 2 or 3 cuts this year. It's probably going to depend on a couple things. Again, we want to see at least inflation marginally move towards 2%. And we
right.
also want to see that the labor market, unemployment probably rise a little bit, because when that happens, the Fed is going to get more concerned about over tightening. And so
Mhm.
if you have unemployment tick up a bit, it greatly increases the probability of getting rate cuts.
Yeah. So again, we're talking more about the Fed tinkering versus, an elevator down with massive rate cuts. We're talking, 1, 2, 3 kind of rate cuts. Is that fair?
Yeah, yeah, absolutely. That's so I think a lot of people, so again, we've talked about this last time, Michael. People tend to look at uh, base their view of the future on what they experienced in the past. So what we've experienced in the past is that something bad happens, Fed goes to zero, and then uh, you know, goes
Yeah.
out and starts buying assets. But this time it's different. It's different because the Fed is cutting not because there's some huge calamity, not like it's the great financial crisis of 2008, not like there's a COVID crash like 2020. The Fed is cutting because inflation is coming down, and so they can go
Mm,
slowly. So this
right.
time is different than the last time because the circumstances are different.
Yeah. One of the things that I fear is the Fed starts tinkering. They have a cut. They orient even dovish. That we kind of unlock the animal spirits, right? I think we have record levels of money on the sidelines, both in money market and elsewhere. And should you be able to get 4% instead of 5% in a money market, maybe people move money out of there and then they go back and they start buying assets again, hard assets. And you're doing that in an environment with limited supply. The crash up just continues. Is that fair?
Yeah, yeah. So, like you rightly mentioned, If the Fed were to cut rates right now, I'm sure everything would start to surge even more than it already has. Now, a lot of people in the market would point to this and say financial conditions are loose, so the Fed shouldn't cut. So, but that's not really how the Fed looks at it, because the Fed has been asked, well, Fed officials have been asked many times about this, and they've been very clear. So when they're thinking about whether or not they cut rates or not, they're not really focused on the stock market, which
Mhm.
at the moment they think, that's just Magnificent Seven, right? I
Right.
shouldn't conduct monetary policy based on what Nvidia is doing. So they're looking at things like inflation, like unemployment. And when it comes to the transmission of interest rates, they're looking at things like financing rates. So they're looking at mortgage rates being very high. That's slowing down the housing sector to some extent. So they're looking at that.
For
They're
sure.
looking at credit card rates very high, and so a lot of people are falling more behind on their credit card payments. So they're looking at that and saying, yeah, high interest rates are weighing down on the economy. We should focus on this stuff, rather than what's happening with Nvidia.
I love it. Well, let's kind of step back and let's talk about the average Joe and Jane, right? The average Joe and Jane, not deep into what the Fed's doing, not in monetary policy. Shoot, never taken an econ class. What are two or three of the things you think the average Joe and Jane should be looking at in the media to kind of just get a feel for where we're going? Any thoughts on two or three things you would recommend a novice look at?
Well, first off, if an average Joe or Jane, I think, knows much more about the economy than someone who's studied economics, because a lot of the tools and theories, in my experience, are just not very useful in understanding the world.
Very true. Very true.
um, So, I think we're in kind of a difficult time for the average person, because on the one hand, you have a lot of things that people have been accustomed to having, like housing and so forth, and going to college becoming more and more expensive and out of reach. And on the other hand, you're moving into a world where it seems like people with assets just continue to get farther and farther ahead of everyone, and it's more difficult to catch up. So I think we're going to be in a period where for a lot of people it's not going to be the best of times. I think this is a process that countries go through throughout history, right? We have these huge um, periods where maybe things become less stable because so many people are left behind. So I would be, I think, worried about social stability and try to be in places where I feel like there's a stronger sense of community, stronger sense of social capital. And I would try to build skills to make myself, I guess, more resilient to what could be happening in the economy. So
Mm,
when I look around in the world, I feel like there's a lot of people focusing and learning things that just aren't useful, be it economics or being it something like, just random stuff you read in college. That seems to be kind of a luxury almost. So maybe having
gotcha.
some actual skills, actual trades, would be more useful to the average person in order to have, I guess, a good living. So
Yeah, it's funny you
I
bring that
guess,
up about the trades.
yeah,
That
yeah,
is that's a great point.
I would say that a lot of sometimes, the future doesn't always look like the past, and a lot of the things that we've been brought up to do, to learn, those paths worked before, and maybe they won't work as well in the future. So to be a bit more open-minded on that, so like we were discussing, maybe the trades, maybe these technical skills would be more in demand in the future than someone who say studied English or political science or stuff like that,
Right.
because I'm not sure those add it's a valuable training
Mhm.
anymore.
Yeah. I think one of the things that I try to get people to understand, and it sounds cute, um, but I actually believe it, and that is inflation's a feature, not a bug. And if you really understand that, it really can help you lean into your investing strategy, right? AE or IE buy assets, 30-year debt fixed, things of that nature. If I were to say to you, Joseph, inflation's a feature, not a bug, would that just make you recoil, or what would you think of that?
No, it depends. I mean, it's a fact. I think it would, if you think that's how the world would be, it's not neither good or bad. That's, you just want to change your positioning, right? If you think inflation is going to be higher going forward, you want to do what you just described. You want to get lots of long rated fixed rate debt, and you want to be exposed to assets that would rise with inflation. Now, for the normal person, I think that's probably going to be some kind of house with a 30-year fixed rate mortgage. Um, but there are also many different ways of doing it.
Sure.
Easiest way, of course, would be equities, right? Equities tend
Mhm.
to go do well when a country is depreciating their currency. If you look across the world, you don't have to look at extreme examples like Argentina. You could just look at a
Mhm.
country, like uh, a lot of the Latin American countries.
Yeah. Yeah. Well, let's fast forward to November. I've never had discussions about November yet, but it's getting closer and closer. Any thoughts on, just how market moving that November election might be?
I think it could be a huge, huge watershed moment because, so like we discussed before, a lot of what's changing so far is the fiscal deficit, and I think President Trump has been pretty open in that if he were to be president, again, we all know President Trump likes the stock market a lot, so there's been reports that he would like to change his policy so that he would have more control over interest rates. So I remember during the first term of his presidency, he would loudly complain that, the Fed is keeping rates too high. Other countries have lower rates. We're at a competitive disadvantage. So he could make moves to try to keep rates lower than they otherwise would be. And there are also reports that he would like to depreciate the dollar in order to make the US more competitive. Now, this would totally be in line with his trade war rhetoric from his first term. As you recall, when he was president, he put lots of tariffs on China and other countries in an attempt to boost competitiveness of US exports. Now, this, I mean, traditionally, if you go to your standard Washington economist before Trump, he would never do this. But Trump really changed the playbook by being willing to put on tariffs. And the next step to conducting a trade war is depreciating your currency, which the US has done before, right? So in the past, the US has, let's say, the Plaza Accord, dollar's too strong. Everyone get together, depreciate the dollar. This is something the White House actually has the power to do. Now, if
Mm.
you have a president who says, I want lower interest rates, I want a cheaper dollar, I want to lower taxes, and also I really like the stock market. I think that's some tail risk there on the right tail side where there's some substantial upside to how high the stock market could go. And not just the stock market, real estate would really benefit as well.
For
After
sure.
all, President Trump did build his fortune in real estate, so he understands the importance of leverage and tax laws and so forth. On the other hand, President Biden, I think he would also like to spend more money, but he also talks a lot about other stuff that would not be stock market positive. For example, trying to have higher capital gains tax or even tax unrealized gains. I mean, could you imagine what a nightmare would be if you
Oh,
had to pay taxes on your real estate that you haven't even sold? That'd be terrible.
yeah. That'd be
So
terrible.
I think a Trump victory would be really, really positive for asset prices. That being said, it'd probably be inflationary and yeah, it'd probably have a lot of other implications as well. But just narrowly looking at assets, which is what I do, I think it'd be very positive. Um, I think a Biden victory would be less clear.
Okay. Yeah, I think that's pretty clear that one side wants to spend more, but also at least it says up here that Biden's talking about raising taxes, capital gains, unrealized gains, all of that. I guess the one question I have about the deficit, last number I saw was 34 trillion. It might be 35 trillion by now, whatever. It's a crazy number. Is there some number or threshold or percentage of GDP that's like a red line in the sand we can't cross, or any idea? It just seems to be going up and up and up, and nothing's pulling it back.
No, there's no number. So the difference between today and let's say 100 years ago is that 100 years ago we were on the gold standard. Eventually, gold is money. You could run out of gold. Now
Right.
today we're on the dollar standard, and you can never run out of dollars. You can just keep printing it, and so there is really no limit to how much fiscal spending there can be. Um, but of course, there will be some real economy impacts. If you continue to spend like this, you would get more and more inflation. Now, eventually, people in the public would lose confidence as to what's going on, and maybe if if everyone begins to think that we're going to have an inflationary time, then everyone will go buy stuff now rather than tomorrow, and that could actually cause a lot of inflation. So a lot of this is sentiment as well, but I don't think there's any limit as to how much money the government can spend.
No, yeah, they're proving they can just keep on spending. That's for
Yeah,
sure.
that's right. Proof is in the pudding. I mean, look at, I don't think
Yeah,
anyone ever,
just look at results.
I don't think anyone ever imagined we could have, 1, 2 trillion deficits uh,
Yeah.
forever, but here we are.
Yeah. One of the things that I'm looking at, this is more as a real estate guy, so this may not be your area. If it isn't, cool. But it's commercial banks, right? The commercial banks are really struggling with the Fed rated, 5.5. A lot of them have some commercial loans that at some point they'll be forced to mark to market. I think lower rates, even a half, which would be 2 cuts or 3 cuts, really could bail some of them out. Do you think the Fed's looking at the banking system and realizing how precarious it might be?
So Fed officials have been asked about this, and they just straight up tell you no. So
Mm,
they'll tell you that they think that the people involved, well, first off, the Fed gets pretty good data on this stuff. They'll say that, we have, over 4,000 banks. Some of them are not doing well because they have too much exposure to certain segments of commercial real estate. As you know, real estate, really, really wide
yeah.
area. You got hospitals, data centers, and you also got downtown office spaces. So some of them are not doing well. But I think Fed officials also will tell you that you've had a year, more almost 2 years to kind of work
Mm,
through this. This is
good
not
point.
something that's unknown. And so if you have all that time, it's unlikely for you to really kind of blow up, right? Because it's really the stuff that you're not able to prepare for that gets you. But here you've had a lot of time. So I think that they are not too worried about this because of that.
Yeah. In the last Fed statement, Jerome Powell, actually it might have been the Q&A, so maybe it wasn't the statement. This might have been the Q&A with Jerome Powell. I thought he made a slight pivot that a lot of people missed. I wanted to share it with you and see if you caught it or what you thought of it. In this last session, he talked about watching both inflation and the job market. I think for a long time it's been inflation only and kind of the job market, be damned. This last session, he talked about the job market, being equally important. So to me, it feels like the dual mandate is back. But I don't know if that was important or
Yeah,
maybe I'm
that's it.
just
You're exactly right, Michael. So, um, like you mentioned, Fed is a dual mandate central bank, full employment and price stability. It's really difficult to weigh these two because sometimes, in order to get inflation down, maybe you have to cause a little bit of unemployment. Now, last year, inflation was, about 8%. Unemployment rate was at multi-decade lows. It was really easy. We're basically a
right.
one mandate bank. Today, like we've been discussing, well, inflation is, above 2% for sure, but it's coming down. Unemployment has also been steadily rising over the past few months. And like we discussed earlier, I think in order to get rate cuts this year, we really need to see that unemployment rate continue to go up for the Fed to really, I guess, become more concerned about over tightening. Now, one thing that's really interesting that's happening in the labor market is that we could have unemployment rate rise, not so much because a lot of people are losing their jobs, but because we have more workers. Now, one
Mhm.
of the big game-changing things that's happened over the past 2 years is just we have millions and millions of people pouring into the country, and we don't even know how many because most of them are illegal. But the estimates are like, say, 3 million people last year.
Yeah.
And so, if you're adding millions of people a year, then you could have the unemployment rate rise simply because you have more people coming in, right? So, the amount of jobs doesn't change, but the amount of people that looking for work increases because they're moving here to look for work. So it'd be a weird situation where the economy, when it comes to, let's say, the goods and services produced, doesn't really change, but your unemployment goes up simply because you imported all these people who are looking for work now. So I think that's a really difficult thing for the Fed, and it'll be really different from the past.
Yeah.
So
Yeah. Absolutely right. Yeah.
yeah,
I've been asked a lot about what if there is an unemployment rate that makes the Fed kind of stand up and pay attention. And the best thing I have to say is the Psalm rule, right? When it's up
right.
0.5% from the last 6 months running average. So my calculation roughly puts that at 4.2. I think the Fed pays attention at 4.2%. What are your thoughts on that?
So every quarter, the Fed gives a forecast. It's called the dot plot, where they think, Fed funds, inflation, unemployment rate will be at the end of the year. Now, their expectation, I believe, is for unemployment to be about 4.1% at the end of this year. So if we were to get there earlier, I think that would get their attention. So
Okay.
yeah, like 4.1, 4.2, that would definitely get their attention, and you could expect the market to rapidly price in rate cuts if that were to happen.
Yeah, I agree with that. Speaking of the dot plot, we get our next chance at it. I think it's June 12th. They
Yeah,
do it
yeah, very
once a
soon.
quarter.
Yeah, just in a few weeks.
Yeah, once a quarter. It's always funny when you think about the dot plot. They talk about unemployment, inflation, GDP, and there's one more number I'm missing, but they always give their kind of forecast. Oh, interest rates. Interest rates was the last one. I actually got to tell you, I was disappointed in the last dot plot. So we're talking 3 months ago. No Fed president talked about going higher. I was disappointed. Not even one of them had the balls to say we might need to go higher. Now, since then, Michelle Bowman has said we might need to go higher, and I think one other. Um, do you think there's any chance one of them stands up and goes, you know what? We may have to go up one more time?
Michael, I thought this was a real estate channel. We can't be can't be asking about rate hikes. So Michelle Bowman is a well-known hawk, and she will always be the most hawkish person, and she'll always say things about rate hikes. The market was, having some having pricing in some probability of a hike this year, but that's all taken out right now
Yeah,
because over the past few weeks, the really important people at the Fed have basically said that that's not
yeah.
going to happen. That's really, really unlikely to happen. So for them, it's really just how long we stay here and when do we cut and how many times do we cut.
No, absolutely. I think what I saw, we had at least I tracked seven Fed speeches Monday and Tuesday. I think it was four on Monday, three on Tuesday, might be reversed. But basically, all of them are saying we are where we are. We need a few more months of, or no, we need several, not few. We need several good months of inflation data.
Yeah.
And near as I can tell, several is three, right? I'm not sure if it's 3 or 4 months of good data.
When they say that, they will always give themselves an out where they'll talk
Yeah,
about the labor market. So
right.
if we want rate cuts, inflation coming towards target, I think that's harder, much harder than just having the unemployment rate go up, which, like we mentioned before, if you have so many people joining the labor force, you're going to push the
It
unemployment
could.
rate up. Yeah.
Yeah. Yeah. I mean, think about last month, for example. I think we added 187,000 jobs and the unemployment went up a tenth.
Yeah,
Uh,
so the U.S. Treasury has made a comment that was super interesting. They were saying in the past, before we had this wave of migration, we needed about 100,000 jobs a month to keep the unemployment rate steady.
I read this.
Today,
Yes.
we need 200,000.
Yep.
Again, last month we quoted less than 200,000, and the unemployment rate ticked up, like you mentioned. So
Yeah.
I think the unemployment rate will go up.
Yeah. So it sounds like you think the unemployment rate will continue its trend of going up over the
Yeah,
next several months, is what
because
I'm,
we're adding a lot of people. That's what happens.
it's just math. It's just math.
Yeah.
So it would not be out of the realm of possibilities to be at 4.2 by what month are we in? We're in May. So by August or September, that's not unrealistic.
I don't know. I mean, this stuff is kind of, I mean,
Yeah.
when you look at it, it so every month we have economists forecasts from Bloomberg and all these people
Mhm.
focus on it. They're not that accurate, so I think
No,
it's kind of a difficult thing to forecast.
sure.
But I think that from what I see, looking at the soft data, looking at the trend, looking at the GDP growth, it seems like the economy is still growing, but it's slowing down.
Sure.
And at the other hand, on the other side, the amount of people joining the country continues to grow. Again,
Yeah.
so weakening demand, increasing supply, that's going to push the unemployment rate higher. So
Yeah.
exactly
Yeah.
how much or when, I think that's hard to say.
Yeah. The other thing I would love to get your thoughts on, historically speaking, people think about the Great Recession. If you're Gen X, you might think about the dot-com recession. I've been trying to help my audience realize that we might be going through what's called a rolling recession, uh, which is not certainly not a normal recession that the average person is used to. Um, when you look at the economy and think about different segments like interest rate sensitive housing, depression level, lending, depression level. But now, we're starting to come out the other side. Do you see rolling recession as possibility, or you don't think about that?
Well, that seems to be what happened over the past few years, right? You had, different sectors taking turns doing well. In the beginning, travel was booming, right? Everyone wanted to take a trip. I think
Yeah.
that's moderated a bit. In the very beginning of the pandemic, we also had housing booming. That's moderated some. We got uh, AI stuff that's boomed and seems to have come down a lot. So it seems like it is different sectors just kind of behaving in different ways. But the thing is, it's not everything is not slowing down at the same time at once. It's just kind of rotating, like you mentioned.
Yeah, I think rolling recession. Again, it's so uncomfortable for the economists and PhDs of the world because their models don't work in
Oh
a
yeah,
rolling
no,
recession.
no. That's why the average Joe or Jane is going to have a better grasp of how things are going.
Well, the last thing I wanted to ask you about is I think Jerome Powell may have walked into his next great inflation is transitory comment. And that was his comment around stagflation, that he doesn't see the stag or the flation. Um, I'm not sure what he's looking at because the data, at least at the top level, looks to have both stag and flation. What are you seeing out there?
So I think we have just maybe a little bit of stagflation. I mean, if you think back to the 70s, we had strong negative GDP growth, high
True.
unemployment, and inflation was, several percent. So I mean, this is today's very different from that, right? What we do see, it seems like that the economy is slowing a bit, but inflation is a bit more persistent. So I think we see a little bit of that maybe going forward, maybe going forward, I think we're on a path where we would have, I guess, very slow growth and higher inflation, because I think as we go forward, as the deficit continues to, blow out, we're going to have persistently higher inflation. I think people are going to realize what's happening, and that change in perception is going to make inflation worse.
Oh,
And
wow.
of course, as
Yeah.
part of it is, I mean, so
Consumer
people are paying,
expectations.
right,
Yeah.
if people are paying attention, so there's a wide range of people in the country. They have different levels of understanding, different perceptions, different priorities, and so for any group of people, there are going to be people who are uh, more in tune with what's happening, right? And so these people, they're probably watching videos on YouTube, like your channel and so forth, so they're going to have a better idea as to what's happening. Other people may be a bit slower, but the people who are more aware that we're having this very big change in how the country is managed and it's inflationary, they're going to be positioned for this. And as other people become more and more aware, they are going to position for this as well. And that process, I think,
Mm.
is going to make inflation become more serious. Not this year, but in the coming years. Now, as that happens, again, your economy can only grow so much a year, so you're going to have slow growth. You simply just can't grow 3-4% a year in real terms every year. There's a certain capacity constraint. So as inflation becomes, I guess, persistently higher than expected, growth, I think, will muddle through, and we could have more of a stagflationary scenario, not this year, but in the coming years.
No, that's exactly where I'm at. I think stagflation, right? The historical 70s definition is kind of a 25, 26, 27 probability or possibility. Um, it just seems like that's where it's going, right? Where inflation, especially to your point, if the consumer's behavior changes, all bets are off. If they start buying now because they fear prices are going up later, all bets are off.
Yeah, yeah.
It,
And what if a lot of people are waiting to buy houses because they think interest rates will go lower. What if they begin to realize it's never going to go lower? Oh, well, you got to buy now, right? Because
yeah,
it's not going to get any better.
exactly. I think housing is a great example. It's funny when you look at housing. This is a housing channel. You joked earlier. I made another call here recently. I love making calls because I just love watching the game, making a call, and then I own it. If I'm wrong or right, I own it. I have no problem being wrong. I'm wrong all the time. But I talked about something called marginal demand. I've been watching consumer behavior, and it when we were at 7.5% mortgage rates which was about 4 weeks ago. The marginal demand was like, I'm waiting on the sidelines. I'm waiting on the sidelines. Over the last 2 years, we have seen a couple of different times where rates went up and then they came down sub six. Both of those times, marginal demand was unlocked, and we can look at the data to show us, oh, look, rates mattered. Well, now we're at or just above 7%. I'm curious, you know, where is that marginal demand unlocked? Do you ever look at data in that much of detail at all?
I'm gonna have to defer to you when it comes to housing. But it looks like, there is a lot of demand, and from what I hear, people are just buying smaller houses or buying farther away from where they'd like, but they're still
Right.
buying. So that kind of changes what they're able to buy, but not so much as to whether they will buy.
Yeah, they're making different Yeah, we're still doing 4.2 million transactions. We just got NAR's report this morning. Again, record high. I think it was 436,000. So no crash, up 5.6% year on year. All data came out today. You can check NAR's website. So Joseph, at the end of the day, crash up, still a thing, still going forward?
Absolutely. Crash up is something that's going to play out in the coming years. From my perspective, it's not going to be a straight line, but I think the trend is solidly higher. This fiscal deficit, 6% a year forever, is really game changing. So your past playbook will not work. It's a
Throw it
paradigm
away.
shift in how the markets will work going forward.
Folks, crash up. Do me a favor, give Joseph Wang a follow on X or Twitter. It is Fed12, Fed12. Is that right, Joseph?
Fed Guy 1-2.
Oh,
And
Fed Guy 12.
and
Sorry.
if you're interested, of course, every week I have a YouTube channel where I provide a weekly video as to what happened in the markets the past week.
I love that. Do you have a standard publishing date? What date is it
Yeah, yeah.
every week?
Saturday morning. The channel is just
Oh,
called Joseph Wang.
oh, go check him out. Joseph Wang every Saturday morning. I don't know why I did not know that. Got to check you out Saturday morning. Joseph, thank you very much for being here, man. You're great.
My pleasure. Thanks for inviting me, Michael.
Yes.